The imposition of a 70% tax on banks' foreign exchange gains, as outlined in Nigeria's Finance Act 2023, is raising alarm across the industry. While the act aims to foster economic growth and promote stability, many fear that this tax could do more harm than good. The Bank Directors Association of Nigeria (BDAN), led by Chairman Mustapha Chike Obi, has strongly opposed the tax, calling it excessively burdensome and poorly timed. With the banking sector already dealing with economic uncertainties and recapitalization efforts, Bank Director Association of Nigeria is urging the National Assembly to reconsider this move and engage in open discussions with industry stakeholders. In today's video, we will dive into why this tax was introduced, its potential impact on the banking sector, and what it could mean for Nigeria's economy.
Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos.
Let's start with the definition of windfall taxes. A windfall tax is a levy imposed by the government on companies that have achieved unexpectedly high profits, typically as a result of favorable economic conditions. These taxes are usually designed to capture a portion of these excess profits for public benefits, such as funding social programs or reducing fiscal deficits. This 70% tax is a type of windfall tax meant to capture profits banks made from favorable foreign exchange movements, particularly following the Naira devaluation. Historically, windfall taxes have been applied across several sectors globally. For example, in 2022, the UK government introduced a windfall tax on oil and gas companies to capture gains resulting from soaring energy prices due to the global energy crisis. Also, in 2008, during a period of record high crude oil prices, the US implemented a windfall profit tax on oil companies to curb excessive profits and generate revenue for public programs. So why the opposition? While windfall taxes can make sense in certain industries, the Bank Directors Association of Nigeria argues that the 70% tax on banks' forex gains is excessively high. It is clear that the tax would harm the banking sector, which is already dealing with economic uncertainties and recapitalization efforts in different ways. These include financial strain on banks. Such a high tax rate puts immense pressure on Nigerian banks, limiting their ability to invest in innovation and technology, both of which are essential for staying competitive in today's fast-changing financial landscape. Impact on credit availability. If banks experience reduced profitability, they may become more cautious in lending. This would limit the availability of credit to businesses and individuals, potentially slowing economic growth. A heavy tax burden. Nigerian banks are already grappling with other levies like the Asset Management Corporation of Nigeria levy. When combined, these taxes make Nigerian banks some of the most heavily taxed in the world, reducing their ability to compete internationally and stifling growth. Some of the issues raised regarding this tax include ambiguities in implementation. One of the biggest concerns raised by the Bank Director Association of Nigeria is the lack of clarity in how the tax would be implemented. The Act doesn't specify what constitutes taxable forex gains or how banks should handle forex losses. Moreover, it's unclear if this 70% tax will be applied on top of other existing taxes such as the company income tax and the tertiary education tax, increasing the risk of double taxation. As a result, Banks Director Association of Nigeria is calling for clear and detailed guidelines to ensure fair application across the country. Without this clarity, banks face more uncertainty in financial planning and reporting, potentially leading to disputes with tax authorities. Lack of stakeholder consultation. Another major issue with this tax is the lack of consultation with key stakeholders in the banking sector before it was introduced. Banks Director Association of Nigeria stresses the importance of including key industry players in the policy-making process, especially when such significant changes are at stake. Had there been more open dialogue, a more balanced approach would have been taken. This could have allowed the government to meet its revenue goals while considering the practical realities faced by banks. The absence of stakeholder engagement highlights a disconnect between policymakers and the sector, increasing the chances of unintended consequences that could stifle growth. To put things into perspective, let's compare the windfall taxes in other jurisdictions. United Kingdom, 1997. The UK imposed a windfall tax on privatized utilities such as water, electricity, and gas companies which had made substantial profits following privatization. The revenue raised was used to fund employment programs and social services. This tax was widely viewed as successful because it targeted companies benefiting from regulatory advantages rather than business innovations, and the use of funds was transparent and well communicated. United States, 1980s. The United States introduced a windfall profit tax on oil companies during the oil price surge of the 1970s. While the tax raised significant revenue, it was eventually repealed in the 1980s due to its complexities and concerns that it discouraged domestic oil production. This illustrates the importance of balancing tax policies with incentives for industry growth. Australia, 2012. Australia introduced the Mineral Resource Rent Tax (MRRT) on iron ore and coal mining companies to capture super profits during a commodity boom. The tax faced significant opposition from the mining industry and was ultimately repealed due to its lower than expected revenue generation. This highlights the importance of stakeholder engagement and realistic revenue projections when designing windfall taxes. In each of these cases, careful deliberation was required to ensure that the tax did not stifle industry growth or discourage investment. Consequently, Bank Directors Association of Nigeria urges the National Assembly to reconsider the 70% tax on forex gains and engage in constructive dialogue with stakeholders in the banking sector. Key recommendations include reassessing the tax rate given the current economic conditions and the banking sector's role in economic recovery, providing clear legislative guidelines to resolve ambiguities around what constitutes taxable forex gains and how losses should be treated. In summary, while the 70% tax aims to boost government revenue, it risks hampering growth, innovation, and lending capacity. To ensure a balanced approach, a reconsideration of the tax rate along with open dialogue between the government and key players in the industry is crucial for fostering sustainable economic development. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.